Our first presenter for the morning is Nick McCoy, one of the managing partners of Whipstitch Capital. Now, Whipstitch is a leading investment bank in the natural products space. I've known these guys for years, and they've worked with brands like KeVita, Spindrift, CORE, Essentia, and more, both on growth capital and strategic exit deals. Nick McCoy, who's going to present, is a numbers freak. He is a data junkie who sees where all the money is gone and who unwraps the paperwork to put a deal in the best possible light for investors. So, knowing that, I put Nick on the spot with the presentation. I said, don't just give me a talk about the state of the market or about investment in strategics. We want something that's going to help entrepreneurs understand patterns within the beverage category. And that'll hit those focused brands who are starting in a single channel or on a D2C basis, as well as those built for scale, massive investment, and exit. He's going to give us growth paths and where beverage and where investment affects beverage companies. And I really appreciate all the work he's put into this. Please welcome Nick McCoy. This is yours.
Excellent. Hey, everybody. Good morning. I hope everybody's drier than me, because when I looked out at 8:10, there was no rain, and I made a really bad call, and it was not to leave then, and instead wait 10 minutes and then try to call a lift. So that means you're going to run through the rain with a parka on. What are you going to do? And by the way, Jeff, thank you very much for the data geek in finance being cool, because 25 years ago, when I was getting into finance, I felt pretty nerdy, actually. So I'm glad it turned out to be cool 25 years later. You wear it well. Okay, so really quickly, Whipstitch Capital, what we do is we work with brands as they're growing anywhere from very, very early on until they're much larger in helping you raise money, primarily from institutional investors, also helping you sell. We also do work with some large companies in helping them evaluate M&A acquisitions. Actually, a lot of what we do is also getting to know people before we work with them. So I would say I probably talk about 10 times the number of business plans and advise informally on 10 times the number of companies on an ad hoc basis than we actually have clients, just through relationships that we develop over the years. That's one thing I love about this industry, by the way. It's a very big community, and I'll tell everybody what you give, you get back. The next two slides are just a smattering of deals we've done. I'm going to go quickly because I don't really want to talk about Whipstitch here too long. There we go. Okay, so starting off, M&A and food and beverage. Food and beverage get lumped together because you go to Expo West and that's a lot of what's on the floor. So I think when you think about mergers and acquisitions and valuation and getting funded, people tend to lump the two together too. And I think it's worth drawing some distinctions because they are quite different. First of all, food and beverage models are not the same. In beverage, distribution is much more important. Beverage companies typically need more capital to get from the time they start to exit. There are fewer categories, and there's a higher perception of competition within each. And what I mean by that is, if you're a large company, you tend to have a pick in this category and a pick in this category. Unlike beer, which Molson Coors or somebody might have 50 brands. It's a little bit different, particularly in non-alc beverage. Usage occasion is also a very significant factor. I'm going to talk about that more. Food and beverage companies are not valued the same. They are typically higher for beverage. If we ran the stats from 2014 till now, and we found that they were about 30% higher, 3.3 times revenue versus 2.6. The transactions are not equally frequent. Food is about 3/4 of all deals, looking back over the same time period. And if you think about the sales channel, it's very different too. Food companies can sell online more easily. Beverages are just not dollar dense. It's very expensive to ship a pallet of a beverage, which is heavy, 3 times in Amazon to get to somebody's house. They do it, but not as much as something very, very dollar dense like supplements, which are perfect. And there's more alternative channels too. You can start beverages in food service. You can start them in things outside of the box and get seen, and it's harder to do that in food. So summing it up quickly, beverage has less categories than food. The distribution, as you get larger, this is a good point too, DSD gets costlier, right? You get to a certain point, you need to go DSD. Whereas when you're in food, you get to a certain point, you get to go direct, and you get a price break, and that's great. The buyer universe is primarily large companies for beverage, and that's because it takes longer to get cash flow positive. And for food, it's both strategics and private equity. Profitability is later stage, and usage occasion is really important compared. If you look at some recent highlight deals, you'll see about a third of these are beverage, kind of right along the lines of what I'd said before, 3/4, 1/4. One sidebar here, Moxie. The trend here of starting better-for-you beverage is actually an ancient trend. Moxie was founded just before Coke by a homeopathic doctor looking for a better alternative that didn't contain cocaine and alcohol. So we're all timeless here in our efforts here. It's nice to know. Again, private placements, same thing, about 3 to 1. Beverage deals are getting larger, and they're actually getting more frequent too. If you look over the years here, you'll see the trend is going upward, and transaction volume too. And there's a number of reasons for that. Independent brands are also growing before they're getting bought. If you look at kind of the big 3 deals over the last 2-year periods, BevNET and CORE are much, much larger than what you've seen previously. And that's interesting. You have to go all the way back to vitamin water to really see that in the past. And there's some commonalities as to why. The brands themselves are getting larger, and this is really interesting. When you look deep into the data, you'll see there's kind of a real rising tide. If you look at and this is the health and wellness set within SPIN, so everybody knows. So this self-selects a little bit toward beverages that are more innovative and better for you, which is, I think, a lot of what we are here. If you look on the right here, you'll see that the top 200 brands are broken out. And if you look at the 100 through 200 brands, those are the ones that are kind of between, I don't know, maybe 10 and maybe 50 million in revenue, or a lot of what's here. Those brands are growing about twice as fast as the brands that are between 1 and 100. So when you think about it, there is a rising tide for innovation within beverage, and the data proves it. And I think that's just really, really interesting. Okay, I need a click here. Oop, there we go. I must have something really dense in this slide. Sorry, I lost it. Okay. The trend in beverage growth is across all channels too, and this is important. So both in MULO and in convenience and in natural, where actually the volume of dollars, the usage occasion, and the dynamics are all different, the growth is very consistent. The number of brands is also increasing by channel. And this is really interesting. In a minute, I'm going to be talking more about this, but when you think about the actual boxes, the store boxes, they're about the same size. But we're looking at between 7 and 10% more brands over the last 2 years. And I see this in food too, by the way. This trend has been going on for a while. And it's actually interesting because that's more opportunity for new brands to go in, but it also means that there's, the dollars are getting more and more split, and that's diluting the big brands. It's not just customers turning away, there's actually dilution on the shelf. Oh, I'm slow here on this click. There we go. Okay, so one of the reasons why the beverage deals are getting larger is that large companies really need to have large brands to be profitable. They have an incredible brand management machine, which I think we actually underappreciate. Because if you think about it, from the field to the shelf, they're completely integrated. They've got somebody in charge of each area with micro focus, and they can pull together a meeting in 2 days to do a package change or a reformulation. And that's just incredible, because if you're a founder of a brand, you've got to outsource your manufacturing. You don't even think about procurement until you're 8 million, and it's only because you got a spike in your sugar price or whatever it might be, right? So they have this great asset, but it doesn't work very well below about 300 million. It starts to get unprofitable. And if you're a founder brand, it starts to get unwieldy to grow and manage your business unless it's very simple and narrow over about 50 or 100 million. You start to outgrow your co-packer. There's all kinds of things that happen that make it more complex. And in the middle is something what I call the gap. And that is that is the kind of $100 to $300 million beverage brand, which starts to get large to manage, but might be a little bit too small unless it's growing very, very rapidly to be bought by a strategic. And if we can actually figure out a way that large strategics can make $100 to $300 million brands profitable, I think we will see a very large increase in M&A. And I can tell you I've had a lot of conversations with a lot of large companies and thought leaders, and this is a very intriguing topic, but nobody has the answer. And I think it's because there's such a divergence in when you look at the dynamics of a small brand where there's no limit to the upside for an entrepreneur, whereas a large brand, the compensation is salary and bonus for a brand manager. The risk is financial failure versus termination of employment. I mean, these are very, very cultural differences. And when you sell to a strategic, it's like flipping a light switch, going from one to the other. There's nothing in the middle. The scope of decisions, you can even change your brand as an entrepreneur. You can't do that. You're just basically growing a brand as a strategic. Capital requirements, obviously very different. The value chain, you're the brand manager of a founder. The founder is the brand manager, and everything else is outsourced. In a large company, it's tightly integrated. And the objective for a founder, and this is perhaps the most important from some of the feedback I've got, is that your brand is your mission. And survival is almost a necessity, and that's why you're raising money. But first and foremost, many, many brands, the mission is really first. And that's very different than fighting for market share. So when you think about it, over time, and this is actually something where Beverage, I think, has led food, large strategics have actually kind of hedged this risk by doing things like two-step deals and creating minority investment groups. So in minority investment groups like Coke VEB or Pepsi's Naked Emerging Brands, they'll go in and take minority investments. And sometimes these things are contemplating two-step deals where they would buy the rest of it later on. And a lot of times they just get on the balance or get on the cap table with a small investment. And I'm seeing this activity more and more, and it's very private. There's not a lot of these announcements out there, so you can't Google and find, press releases. Sorry, Jeff, not much to write about there. In the middle, there's actually not that much activity. There are some, once you get to 100 million, you start to see some strategics making larger investments, but you really don't see a lot of activity unless you see a brand that's growing very, very rapidly. Something like when Pepsi bought KeVita, it was growing at, if you look at Spin's numbers, about 100% a year, and it's continued to do so. They had a lot of confidence that that was going to bridge the gap and become a profitable $300+ million brand because of the growth momentum. So if you're in that range and you're growing very quickly and you're at low ACV in your channel, so there's a lot of room for upside, or it's very easy to see that you could extend your brand into other areas that are less than a degree of separation away, then you're really ripe for acquisition. And if not, then you need to grow the brand and get to about a $250, $300 million level. And that's happening more and more too as brands get larger. So historically, we've all been kind of going down what I call path one, and that is you raise a ton of money, you grow as quickly as you can, you really do whatever you can to push velocity, and you get your ACV out there, and you're going to get a multiple of revenue based on your growth and how large you are. And gross margin, of course, and lots of other things. But the primary objective is growth and getting to the 300 million. To exit to a big strategic. Path two is really something I'm seeing more in food, but it is coming to beverage. I'm starting to see the gestation of it. And that is that you can grow a company in a niche. So early on you say, hey, I'm going to have a niche, and this is not going to be a $300 million brand. It might be 50 or 75 or 100, but I can get a price premium for my niche. And that means I can have a higher gross margin, and I can get EBITDA profitable earlier. I'm going to raise less money, and my exit options are not just strategics, but also private equity. And generally speaking, if you get to a $10 million EBITDA level right now, there is a tremendous amount of interest, both from strategics, because you're profitable now, international and domestic, and that de-risks things tremendously, but also private equity. That's a group of the buyout firms, not necessarily the VMGs and the Kavus of the world that have been investing in companies, growing them, but the buyout firms, the ones that want to buy a majority stake in your business. And they've been really starved for branded products because all of us are generally speaking break even, so we don't have EBITDA that they can borrow on, and there's just not that base, and they see all this innovation and they can't play. So that's great liquidity in that market. If you look at the numbers, the founder ends up in about the same place. So another thing I was thinking about is what are some of the things, the opportunities that we have, that I think are going to play out over the next few years that are going to help us continue to keep that tide rising. And one thing that dawned on me is when you think about these brands like the Buys and the COREs of the world, they're getting these really big prices. A couple years before they sell, you start to see them everywhere. You walk around New York and they're in every little bodega. They're in convenience. They just get themselves exactly where people are. And again, it's because usage occasion is so important. If you can be where somebody wants you to be when they're going to grab you and drink you, you're going to sell a lot more. And Beverage is unique with that because that doesn't work with pancake mix, right? If you put pancake mix in a convenience store, nobody's going to rip the box open and drink it on the way home, right? It's not going to happen. So what's interesting to me is if you look at the top 10 beverage categories in MULO, which is basically conventional grocery, and this is, again, the health and wellness piece, you can see there's a nice little distribution there. Obviously, performance beverages is leading, and it goes down. And there's a couple refrigerated ones mixed in. But you can see the slope of the curve, and there's good growth along the way in each one. If you flip to convenience, the curve is radically different. Convenience is an energy business right now, and also performance beverages, which is like, the Gatorades, Powerades of the world. And there's also good growth there. But it's a radical difference. And because of that, it's very hard for, historically, for people outside of those categories to go there. I have friends that say to me all the time, geez, I walk into a convenience store and there's nothing for me to buy because I'm not going to drink, an energy drink, or I'm not going to drink a whatever, Powerade. I want what I'm going to get at Whole Foods, and it's not there. And I think that's a really big opportunity, and you can see how that plays out in this data. What's encouraging is when you actually look at the top 10 dollar growth categories, so these are the ones growing by dollar in convenience, and you look far to the right, you'll see kombucha is growing 50% a year. And if you think about the kombucha market, it actually is very, very underpenetrated in convenience. And that's an item that, I don't know, when I go fill up my tank, I would love to grab a kombucha, more times than not, and it's just not there. So when you start to see, oh, and by the way, that's also refrigerated distribution, which is a big challenge for all of us in beverage. And if you look at his convenience stores and you look at those top 10 categories, they're all shelf stable. And so it's encouraging now to start to see that refrigerated distribution, that might be getting cracked within convenience. And that's going to open up a few things too. When you think about velocity, or if you took all of these stores and you basically average the sell-through rates, you can do that using spins in a concept called dollars per TDP. One TDP is one SKU in 1% ACV. So if you have one product with one SKU and you're in every single store in the country, you have 100% ACV, that would be 100 TDPs. So $1 per TDP is a great way to look at channel velocity. If you look at MULO or conventional grocery, brands that are between 1 and 5 million average about 96,000. Those that are between 20 and 100 average about 153. So just the fact that you're that much larger, you have about a 50% growth in your velocity by being big. That's brand blocks, mind share, all the things that happen as you grow your brand. It's nice to know that there is a rising tide in velocity. As you spend money and build your brand, you're going to get rewarded automatically by being big. In convenience, that spread is even a little bit larger, and particularly as you get to the 20 to 100. And also, in convenience, if you look, the dollars per TDP as an absolute number compared to MULO is 2 to 3 times. So if you can get into 1% of convenience stores, you'll sell 2 to 3 times as much as you will in grocery, which is amazing because you think back and you say, well, there's really nothing but the beverage, there's really this opportunity because it's so much energy and performance. If convenience stores start to look more like the cold box at Whole Foods or in the grocery stores, it's going to push a lot of product that's not getting bought because it's not there when people want to buy it, which is so important in beverage. It's a real missing opportunity, and that's going to grow brands a lot bigger. I thought after I looked at this data, because energy was so huge, that the energy category itself is what was driving the dollars per TDP because it is a high number. So I took a look at what are the top 10 categories in spins and what are the dollars per TDP in convenience compared to MULO. And you'll see the consistency here in every category, it's about 2 to 3 times. So it's not just energy, convenience moves product quickly. And that's it for slides. I think just as a quick summary, I would say brands are getting bigger, the opportunity is getting larger, the tide is rising. Getting into alternative channels to start and moving into fast, velocity channels as you get larger is all very important to grow your brand. If you feel like you have a niche and you feel like you have something that people are going to spend 20, 30, 40% more than a conventional alternative and hold that, and you can be profitable, you might be able to grow a little more slowly, raise less money, and exit separately. It's a trend that's early, but it's coming. And I know Jeff's got a couple questions here.
Yeah, and anyone feel free to text or tweet your questions.
Yes.
Thank you very
Thank
much.
you.
Oh, the clicker.
There you go. Sorry, it wasn't working very well.
Hey, let's have a seat.
Hey, it might work better now.
Yeah, no, it might work better now. Either that or you're just super wet and, it leached into the clicker.
I thought I was going to short circuit my mic.
That would be bad. Good thing.
That would hurt.
More than you. So one of the things we talked about when we were putting this whole thing together was another way of bridging the gap for brands might be sort of through a roll-up that pulls a lot of those back office and potential production synergies together, either from D2C brands or niche brands. What's your understanding of that likelihood, and what would need? Did you see it on the horizon?
It's actually a really interesting question, because if I think about roll-ups classically, EBITDA and cost savings and synergies has kind of always been a driver. If you think about consolidating industries, and I think within food and beverage there has not been that much success in the multi-brand platform and getting a lot of savings. I would say that if you were to bring together a bunch of smaller brands that would get less than 10 million of EBITDA each, you would create a platform with enough size to get private equity. And I also think about things that are, distribution companies like, KDP, where they have a big distribution asset and how they have multi-brands. There's a lot of synergy there too. So, hypothetically, if somebody had a distribution underlying because it's so important in beverage, it could work there.
So pulling together, aside from just distribution, what about pulling together a bunch of high revenue brands or high growth brands rather than a more offensive focused roll-up? Do you see any of these buyout firms starting to look that way?
Absolutely, yeah, totally. I think buyout firms are looking more and more to try to get platforms of companies to create, ultimately profitability and a bigger sale.
Can you talk a little bit about the role of gross margins in pulling these sales together?
Sure. So gross margin is kind of your real revenue. I like to look at it that way. Gross margin is really tricky because when you start off, it's going to be lower than where it's going to be. And as you get a little bit larger, you're going to figure out, through a little bit of scale where it's going to go. And it's going to grow for a little bit. And then, of course, you're going to get into DSD, and that's going to hit it. But basically, the higher your gross margin relative to things in your category, so obviously for milk, it's going to be low. But if you're in other beverage, 40, 50% in some things, kombucha's higher than that, is really where you want to be. And if you can get to a 60 or 70, you probably have that niche product that people are going to pay a premium for.
Let's talk about that gap that you identified. And we've already, in my first question, we talked about a scenario, something that might happen. And we've talked about sort of the way that strategics are trying to figure out ways to make it across that gap. Now, for the entrepreneurs, let's pull back and talk about for those entrepreneurs who are sitting right now and not seeing that happen, what's the best strategy to leave them in having the best possible outcome for themselves and for their teams? Should they sell before they hit that gap? Should they sell in the gap and say, hey, we're going to hand it off? Or should they wait until some of these strategics start to figure out better integration plans?
So really good question. And I think the answer is going to vary a lot by company and category. if you have a rapidly growing beverage and you can early on get the attention of a strategic and even get them in there for a small minority investment without a lot of strings, then that's somebody who's watching you very closely, and they can start to think about all the things in that kind of brand management value chain and your brand and how that fits. And as you get larger, they can take more risk in buying you deeper into the gap through that knowledge.
So that really is an endorsement of the two-step deal then.
But it's not a two-step if they literally have a no strings attached.
Okay.
You know what I mean? It's just they're a little bit closer.
Purchase.
I'm seeing more of that.
Yeah. Well,
Again, they're not announced.
Yeah, but we certainly saw it with body armor, right?
Yep.
That said, you're seeing more of it. They're not announced. How viable an option is it?
I think it's viable for a lot of brands. I think you can network early on when you're talking with investors, and there's lots and lots of investors in this sector. You can talk with the strategics and their venture groups, and you can get on their radar screen.
Now, certainly yesterday we saw a diversity of folks who were coming in and looking at the space. And in fact, one of them did have a distributor attached, and that's been a big advantage. With all this new money coming into the space, newer VCs focused on beverage companies, how should brands think about partnership?
It's actually a great question, because more investors means more options. And there's historically been a little bit of a funding gap, say between like $1 million and 4 or 5. It's always been hard to kind of raise rounds with value-add investors there. It's nice to see some expertise and liquidity coming in. I also would say, as you get larger, some founders have a tendency to fall in love with the first investor that comes along. But really spending the time and getting to know more investors and building those relationships and understanding them is so important, because once you have a large investor on your cap table, you can't get rid of them. You can actually get rid of your spouse more easily than you can get rid of your investor. And that sounds really callous, but you need to think about it that way, because it's so true.
And
you can have 2 investors, but only 1 spouse.
And your spouse is going to walk away with half the investment anyway.
But you don't want your investor to walk away with more.
Or your spouse.
Right.
Thank you very much for the time.
Thank you.
Be here all day?
Yeah. Thanks.